Hello, this is a video about measuring the performance. Well, not measuring the performance, but about giving a developer or another party a strong incentive and giving upside cash flow to one party in project finance and not to the other party. You can only give it to one. Duh. Okay? Now, so it's a project finance video and it's about performance incentives. Now, I've actually done this elsewhere. Okay, and here it's kind of awkward for me to say this, but my stupid emails, sorry about that. The In project finance, I have this thing called Modeling Tax Equity Structures U.S. Renewable Energy. I'm going to change the name of this because these structures where you have, it's called a flip structure, when one party gets most of the money first, and then once an IRR is obtained, the other party gets the money after that. I call that a flip structure, and I go through the fundamentals of flip structures. Now, there are going to be three sections of this. Excuse me, I can't seem to click on this website appropriately. And then I have a little discussion of the whole thing, okay, and how it works. Now, that's not unique, not at all unique to U.S. tax equity, because what happens is I'm going to use a little financial model that we made. And in this financial model, let me just go through some fundamentals. You better color the inputs, not the calculations. You better never, ever have an input. Sorry, I'm digressing about this. That's in the main body, and you better put all of your inputs before this. And please, nobody ever uses this, but use generic macros, please. I'm crying about this, not because I'm not making any money out of this, but I want you to structure your sheets and not waste time on coloring. Some people say I waste too much time on going through this generic macros in my stupid classes, but I do that to be efficient. And then, so after we go through all the inputs on refinancing, that's what you should do. I'm going to put this on that page I just showed you. After I make the page, I have a hurdle rate for a sponsor. Okay. And then I say, well, if the hurdle rate is less than 7%, and maybe I should put 0% here. So it's 0% to 7, then the sharing percent post hurdle to developer. I obviously have a little bit of trouble. Hurdle rate from and then so from 0% to 7%, the developer gets nothing. Shift Control P, Control Alt C. That's kind of stupid, but I just have to do that. So we'll make sure it's a input color. I'm trying to show you I'm not wasting time on this. I'm actually saving time. Okay, instead of doing all, and of course you can do it much more occasionally. So from 0 to 7, you get nothing. From 7 to 8, you get 30% to the developer. Now, these developers are kind of lucky little people. They're not. They work their butt off with sweat equity, and they have to make some kind of investments. And I'm not going to put their investment in this kind of analysis. And then if the overall project, which could be a equity IRR or could be a project IRR, If you get up to 8%, then from 8%, from this tranche of 8% until the developer gets 9%, you get 40%. And above 9%, we're going to give the developer a whopping 60%. Now, it depends. If this is an equity IRR, maybe it's not so big. But if it's a geared, unleveraged IRR, that's a fair 7% for me is a high IRR. So there's a good chance that they'll never get this. And 9% is a mind-boggling IRR. And don't tell me it's not. And don't tell me there's not a gigantic difference between 7 and 9 on a long-term project. I'm going to be belaboring this and I'm going to be shouting about this so long. The difference between a small IRR and a long-term project is enormous. That's what these Damaradan assholes don't understand. They just can't get it. They throw around cost of capitals and equity market premiums and all this shit. Oh, sorry. Look at me getting emotional. I'm here. Well, I'm trying to show you the mechanics of this. So that's our assumptions. Okay. And how do we implement those assumptions? Well, unfortunately, I've done this, but I'm going to redo a couple of calculations and I'm going to go through kind of the instructions. To do this, you set up this thing, I call it a tracking account. And I learned this from a very big client a long, long time ago. You set up a tracking account. It's almost as like a subordinated debt that has payment in kind, that you don't pay the interest, but you accumulate the interest. But we're accumulating a cost of capital. We're accumulating and seeing when we hit that 7%. And we're not using, here's what you do not do. Do not, no. Do not put an IRR account and an if statement with an IRR. You're going to get some kind of circular reference. It's going to be a mess. Here's what you do instead. Okay. You go down. I'm pressing Control page down. And you go down and somewhere you start with a tracking account. This thing up here, I call it a tracking account. Maybe you have a better name for it. I don't know the official name for it. And what you do is just like any debt account, you set up an opening balance and a closing balance. And then instead of pretend this was payment in kind or capitalizing interest, when it's capitalizing interest, I'm just thinking about something else. Sorry. When it's capitalizing interest, what you do is you take the opening balance and multiplying it by an interest rate. But this interest rate is that hurdle rate I showed you. And then to keep track of the economics, you have to put, how much investment you made. So I have a sources and uses account and I have no debt. So in this case, it's all equity. Of course, it doesn't matter if it's debt. And then you see how much the sponsor, not the developer, put in. I assumed right now the developer put in nothing. We can, of course, change this. So the developer puts in a little amount of money. That would not make any difference. And perhaps I'll show you that a little bit later. So you set up this account. I don't have to show you that the opening balance equals the closing balance. I don't have to say that it's so crucial to put these little numbers here and stop wasting your stupid time putting a total here. It drives me crazy. What a useless thing to put a total on the side. Totally useless. I'm in a bad mood today. Like this kid, not my son, my stepson. Oh God, he crashed the car. God damn it. Now then you put the dividends here, and this is the next rule for kind of anything you do like this. You take the dividends, and you don't know how many dividends you're going to pay until you reach this 7%. Okay, and the dividends come from a cash flow waterfall. It's just like a cash sweep account. And then when you get to the very end, sometime account. So out of that 9.81% equity IRR, the first 7% goes to the sponsor. people who are fancy call this zero carry for some reason. What in the heck does that mean? And then here we get to a point. We get to the point where the closing balance gets to zero, and it's kind of like an equity account, really. This is the dividends. This is the amount you invest, but we're putting this kind of cost of capital, and I call that a tracking account. Now, this is the key. You take this one, and this one comes downstairs from a cash flow waterfall or some variant of a cash flow waterfall. And then when we go down to the cash flow waterfall, this is a standard cash flow water, EBITDA minus taxes minus interest, blah, blah, blah. You get to cash flow to equity, and now you're going to split this. Oh, excuse me, I'm at my brother's house. He's got some kind of whatever alarm clock. Then I put this down. Now we're going to start allocating this. And this is the first big trick. Now, instead of, maybe I'll do this. So if you want, you're going to take this total cash flow up here and allocate the first to the senior. This is the sponsor, the senior cash flow. So you put a minimum account. I didn't tell you. Well, you can first say, oh, the senior man is going to get everything. So you press F4 on this. This is the percentage. Remember, it's 1 minus 0, and then you get that percentage of the cash flow. That's all fine. But then around this, you put a minimum of this, or it's kind of like the opening balance on a cash sweep. So you go up to the wherever we did this. Oh shoot, where am I finding this tracking account? You put the opening balance, the minimum of the opening balance, and then you better add back that's like adding a cash sweep with a cash sweep you deduct it, but you add in the cost of capital. And when you do that, you copy it across, Shift Control R, and then you can go down here and say, well, how much did this first tranche actually get? And I said, well, this is the tranche for the first cash flow. So you put a minus on the first one, and then you put an equal sign, and you go up and see how much he actually got, Shift Control R, and then you get, that's the IRR, and you get the right IRR. And I think you should make a check exactly like this. Now, unfortunately, we're not finished. We've got two things to do. We've got a hell of a lot more. And then the second thing you do is this is another trick. You take that senior cash flow you just computed and divide it by the senior percent. I should put senior. And I'm going to give you this a model. And then once you've done that, you can compute the allocation to the developer. How about this? Let's be so absurdly generous that it's crazy. Let's change a couple of the assumptions. Let's say this developer invested a whopping 3% into the project. And let's say for some reason we're going to give them 2% of the cash flow. So instead of being zero carry, now we as an investor only invested 97%, they invest 3%, and we share 2 of it. Okay, and then we should go down to the sources and uses of funds, and of course I have an error here, and we should put there investment, and that will be this, and for some reason I seem to even have that space there. That was bizarre. Okay, so now we only put 970 into the investment. I hope I'm being clear. So now you can see in our little tracking account, we only put 970, and that means this 7% would be obtained a tiny little bit earlier. Now, you don't put any developer stuff in this tracking account, only the senior. And to get the developer, you go down to the cash flow waterfall, and right after the cash flow waterfall, and this, I obviously made another mistake. This should be 1 minus F60. This should be how much the sponsor gets. And I should, well, I don't yell at me about this one because I just added this. So this would be 1 minus this 2% the developer gets. So we only get 90%, and the developer goes up here, and the developer gets an additional 2%, which is a lot considering he invested only 3%. And what you do then is, here is the big stupid problem. It's this last year. In this last year, what we want to do is be able to multiply, to get this developer amount, we need to multiply it by something. And we cannot multiply it by, but if we're doing this in tranche by tranche, which I didn't kind of explain enough, we need to not multiply it by this, but multiply it by a basis for this, because in the next tranche, instead of getting 2%, you're going to get a whole lot more. And the big trick, and it's a very important one, and I didn't explain it well enough in prior videos, is you take the senior amount and divide it by the 9.98%, so you get back to the basis. This is the total cash flow. Now, in all of these other years, this is exactly the same. It's all the same, but in the very last year, it's not the same, and that's how you can be really precise about the IRR when the flip occurs, because in this case, it's less, because as soon as we hit that, we're going to give the developer a little bit more. So the developer then you just take this amount just above this basis, which again, I'm going to explain it. You need to divide it by the senior percent. That's what we're going to do every single time, and we're going to get there. And then we get the amount that the bonus kind of whatever we call this is the developer. So now when I go downstairs, now we've changed a little bit. The senior only gets the 104, so the senior we took this out of our pocket. Here is the senior, and we only get 104, and then eventually we stop, and we still get to the 7%. Okay, now let's go to the second hurdle. And maybe since the developer put something in and I gave you 2%, let's not be that extreme. Let's give the developer 10% bonus once we reach 7%. Now that's where it gets a little more complicated, and suddenly you're deviating from this US tax flip crap. Suddenly, and let's make this 20%. And make this 30%. Maybe that's a more realistic kind of example. Okay. Then what we can do is then we need to go to the next tranche, and anything, excuse me, I'm going up and down a little too much, but anything between 7 and 8%, instead of getting 2%, now the developer gets 10%. That's their bonus. And how do we do this kind of modeling? And that is a little bit painful. So what you do for subsequent tranches, you start with the incremental cash flow. That's the basis. And this for the allocation. And this is, I say, this is the developer basis. This stuff up here in from part 2. And you take away from that the total minus this. Sorry, it's the total equity cash minus basis from part 2. Okay. Then what you do is you go back to our financial model, okay, and you start entering the basis, okay, and here's what we do. We're going to have, we're going to have a second hurdle. Now, the first thing, the tracking account is almost identical. You use the total investment, and this one, and then you compute the cost of capital to get up to the 8% and find the limit. It finds the limit when we stop the 8% hurdle and go down to the next hurdle. And then you need another item, and that's the tricky part, where you have to go down and get this dividends that you get from the second tranche. And notice I take the whole dividend, so this includes the dividends up here, and you need to include all the dividends, not just the incremental ones. So as you go forward, notice that this one stopped in this year, and then we had the remaining dividends to this tranche number, the senior tranche. This is always the senior, and then you get a little one in the next one. And if we want to kind of cheat and go down to the third one, then you're going to go to an additional couple of years and get the third one, and then you'll have a final one. Okay. I had to, by the way, I didn't know if I explained this well, I had to put the IRR a little bit high so we can see how this works. Okay, so let's look at the second hurdle. So the first thing you do is you say, okay, here's the total equity cash flow we have. Let's look at perhaps the next one. And we take the total minus the amount, this basis amount, not the amount the senior gets, but the total minus how much we get. And the key thing about this one is this period, this first period. So the total cash flow was 137. We gave 14 to both the developer and the sponsor, both of them. That's how much is left over for tranche number 2. Now the first thing is it gets a little confusing. So now I said 90% of that incremental cash flow goes to the second hurdle, but we need the total cash flow. So we use another minimum statement, and I'm going to retype this minimum statement again. So we say the minimum of the incremental cash flow multiplied by the 90%. But here's the problem. We've got to add in the amount you got in the first cash flow, because that 8% thing that was driving it, driving the balance of the tracking account, that 8% was on the total cash flow. So then you go upstairs, and once again you take the initial cash flow plus any amount you make in the tracking. Okay, so I guess you could say that's a little bit complicated of a formula, but tough shit. And then you go, you look at this one. So in the next 2 years, you can see these two amounts. Oh, well, yeah, this was different than the first sponsor or senior cash flow, and then this was again different. And then if you go down and I would always check my work on this, because I never kind of believe it's going to really work. You put the same negative calculation, and this comes from 235. If we look at 235, well, 235, that's the number we just computed. And you put the IRR on that one, and it gives you exactly the right kind of number. Isn't that exciting? And I'm taking my time on this video. If somebody complains it's too long, you turn the stupid thing off. Who cares? Nobody will watch it, maybe, whatever. And then we're going to do the same thing with the third hurdle, okay? And then I'm not quite finished. Here is the problem. I also would like to get the incremental cash flow. I might need to, that goes to the senior, that goes to the first one. So that's 235, which is just this one, minus, you can't kind of see it properly, minus the one amount they got on the first one. So the senior, the extra amount they get is this. And just to re-emphasize that, you go to the incremental for the senior, compute the total amount, which we just did with the minimum function, and include cash flow from prior tranche. Okay, and then after that, we get the incremental amount for the senior as well as the total, and the incremental is senior from prior tranche, from this tranche, minus senior from prior tranche. Okay, so then we I've got to keep concentrating here. Okay, so that's the incremental amount we have, and then we're going to do something almost like this whole basis business where we use the senior tranche, and then we said, well, how much was the basis for the developer? And the reason, again, we needed this, I'm repeating myself, but we needed this to get that last period correct. So the incremental amount from the senior was this, or for the developer, is this one divided by this. Okay, it's a lot easier to make these videos if I have the calculations already there, because I would forget. And then of course we put our special things in the left hand column, and then we can compute the, once we have this basis, we can compute the total, the thing, whatever that is, and multiply it by the percent. Okay, and then if we go down here now, for the sponsor, here's what I need to do. I need to put a minus here, okay? And we can start collecting all of the, I'm looking for the sources and uses of funds that I missed. This is the amount the developer took out, and this is the amount they're getting back. And then, oh, as soon as we get this one, so this just adds in all this, then they're starting to get a lot bigger bonus in the end. And of course, that comes from the end. And then we can also check that the total cash flow is all correct. All right. And, okay, now let's make the last tranche. This is all totally quite repetitive at this time, but it's probably worth repeating some of these, because part of the reason I'm doing this is I know I'm going to forget how to do it. This is one of the things I'd forget. So now we need a 9% tranche, and the developers, instead of getting 20% now, or whatever it was, 10%, I forgot where we were, we'll make a tranche that goes to the 9%. I think I'm there. Okay, and so we go down and we make these, all these tracking accounts are always the sponsor or the senior. When we need a final tracking account, we put the total in here again, and now we keep track of how much we need to accumulate before we hit our 9% hurdle. And this dividends, again, has to be the total dividends, not the incremental dividends. So we just redo this thing. This was what I just did in the previous one. Use the incremental senior to compute the basis for the developer as incremental divided by senior percent. Incremental percent. I can't spell it all. And then we can compute the basis as the, oh, no, ooh, compute as, oh, this is confusing. Okay, compute the, sorry about this. Compute the basis for the, I'll use the increment to compute the basis. That's correct. And compute the developer percent amount as the basis times the developer Now, I hope you can see that I can't type. I hope you can see that we start from 4. I hope. Oh, this is so embarrassing. I cannot multitask anymore at my age. And, oh God, I forgot exactly what I was going to say. I hope you can see this is what I was going to say, that the developer percentage, the developer amount, doesn't need a tracking account. We just needed the basis to get that developer. And then we just go around and around and do it again and again. I hope this is clear. I think for me, I need these kind of things. I need to go over things a few times before I really get it. Okay. So then we've got our third hurdle. Now it's the 70%, and now maybe I won't go through the minimum function again. Maybe I will. We put the minimum. I should say this is now again the last incremental cash flow minus the total, not minus the senior. Oh God, these little things drive you nuts. And of course, I got it wrong 20 times to get this right. So going increment by increment is not quite as easy. I tried to tell it to Hetty at first, and I said, this is easy. Bullshit. It's not easy. Okay, and then you take this one, so you put, as usual, you take the incremental cash flow to the tranche multiplied by this. That's the first step, but you need the total because of that tracking account. So this time you can add the senior incremental, no, the senior total from the last one. See, I got that wrong. Okay, but we're not finished. We need a minimum of this one. And when we put a minimum, we have to go up and take the minimum of the last tracking tranche account we did, which is this one plus the next one. Okay. By the way, Hetty did this before me. She did a better job probably. And then we put that one in, and hopefully that when you put that all together, now this 104 comes from line number 240, which is the total, okay, and then we get exactly the right check. And then we say, okay, well, let's just take the incremental to the senior. So that's how much they're getting this time minus the total, how much they got last time. That's the incremental amount, and we need that. We need that because we're going to take that and divide that by the senior, not the developer, to get the basis. That's this point that the developer doesn't need any. And then we take this amount and we multiply it like this. See, I'm old, but I can still do this kind of crap. And then that gives you the remaining extra cash flow. And if we only have 3 tranches, then you can take, of course, you can have 10 tranches, but you have to have 10 tracking accounts, and I'm too lazy for that. Then you can multiply that by the incremental cash flow, and we're finally here. Now, I almost need a break because I've gone 35 minutes, but I'm going to now, actually, what I'm going to do is take a break. And I'm going to run a data table and see if we start changing all our wonderful little factors. I'm going to put spinner boxes here, and I'm going to make the data table not with a stupid data table in Excel that slows it down, that is unflexible, that's blah, blah, blah. It's horrible. I'm going to see what the developer IRR is and what our senior IRR is if we start changing some of these incentive parameters, some of these flip rates, whatever you want to call them. And I'm going to set it up. So I've got to pause the video. Okay. So just bear with me. You don't have to listen, obviously. It's whatever. Okay. I'm going to make this data table. And the first thing I did was I'm going to put spinner buttons here. So the first thing I did is I put the absolute, whatever, the non-percentages numbers here. And then this is this number, and then you control R. So when you copy that, it just takes the next number, okay? And it copies the little spinner boxes. Sorry to waste time on this. And right now, this spinner box is FK 62. Now in this one, instead of K, we want it to be L. I wonder if you could, when you copy it, take the numbers out. So this one was supposed to be, I forgot, this was supposed to be 7. Okay, and this one, instead of K, L, I think M comes next. Okay, and I'll put the 8 here. And this one is going to be LMN. Okay, and we'll put the 9 here, so forth. Okay, better stop recording. Okay, so now I copied the stupid goddamn spinner boxes to here, and we can change any of our kind of parameters. So we could decide to be a little bit chintzier with the developer here, give them a little less if we have more, but then give them a gigantic incentive. So you really want them to have a strong incentive. Now, once we do that, then we can make a little table here to assess the risk. And we put Alt-EIS, and you put 0.5, 0.05, no, 0.005, and then it'll give you the overall rate of return. Now, it's not that easy, because if we want to change the rate of return, I said that in my first kind of little bit of an interruption, and I said it really quickly. Remember, we changed this and we used this goal seek function to change the rate of return. So now I'm setting up this data table, and this data table would be totally useless for about 8 reasons. The biggest reason, you couldn't put it on a different page. The second reason, you couldn't use a goal seek. So we're going to use a goal seek and test these different structures. Isn't that fascinating? And we might even have a little graph that shows, here's the overall IRR, here's how much the sponsor gets and the developer, and we could put the NPV to the developer if we don't like that, because the developer, if their investment is 0, you can't compute the IRR. I hope you know, if you don't have an investment, you don't have an IRR. Okay, you just get the upside bonus by taking your sweat equity. So what we're going to have to do is make a little data table where we go from row 10 to row 22, and after we make this data table, we're going to fill in the IRR over here. I'm just talking it through to myself to help myself. And we're going to have to fill in this kind of number here. Okay, and once we fill in that number, then we'll get this IRR to the sponsor and to the developer, which is down here, which is, maybe I didn't even really emphasize that enough, but we get this. Here is the, and I didn't even compute this IRR. This is an annual model, by the way. So this developer gets a 14% IRR if the overall IRR, which I computed up here, was 10%. No, this is a little bit odd. Excuse me. The overall. This was stupid. This should have been a minus, and yeah, minus on the total equity, and not and another minus. Excuse me for another error. Okay, there's our 9.81%. So what we're going to do is change the overall IRR by running a goal seek, and then every time we change it, stick in the developer IRR and get these things out. So what that means is, down here, if the overall IRR was 9.81, here I'm going to call this sponsor IRR. We really need this. And then I'm going to call this the developer IRR. And I have to remember what that was. Sponsor IRR, developer IRR. And maybe we'll put a little discount rate for the developer. What the hell should that be? I don't know, 12%. It's got to be a higher discount rate. They're taking a higher risk. And then we can put an NPV and take that number and get up here, this is the developer NPV. And the biggest thing I do is forget what this is. Developer IRR, developer NPV. Those are going to be the outputs and the sponsor. And the input is going to be this this thing up here, the target. I hope I don't already have that. Oh, I already have that. I'll call this target, A-T-R-G-I-R-R. Okay? All right. So then once we have those little things, now I'm going to interrupt the video because I'm going to do it quickly. And this video is about performance incentives and not about making data tables with VBA, which is, of course, the best way to make data tables with VBA. And if you want to see that, of course, you can go. I say, of course, which is a stupid thing to do. My uncle, who I love very much, wrote a book on what is it? The Story of Man. And he said, he's a geneticist. He said, oh, this is very simple. This is very simple. Bullshit. It's not simple. It was really hard. I couldn't have any ideas what he was talking about. This is better tables with goal seek using VBA. So if you really want to see how this works, you really need to go to this page and watch another video. So I don't want to waste too much time with all of that in this one. So what I'm going to do now is stop recording the video for a minute. Where do I stop it? Here. Now let's make this a data table. So you put sub table or anything you want. Table 2 better. Okay, because I might have had another table there. I hope. Okay, and then you put for range row, start row to range end row. Now there's the start row and the end row over here. They have, this is just the row number. It's just called row and column. Okay, those are just functions in Excel. Okay, and while for range for row, don't hurry so much. Napoleon said, don't. Dresser, please dress me slowly because I'm in a hurry. I said that way too much. You've heard me say that. And then we put end call. Now, before you do this one, you better say, okay, let's go to the row. And each time we put the row in, let's take this column, this prior column, and stick this column into the target IRR, but we better multiply it by 100. So we go like this, range TRG. I'm kind of testing myself to see if I can, as an old man, can remember, equals cells, and then you put the row, and you put range, and you put call, and start, with, of course, a double gimme, start, call, -1, and you put, and then you're finished. That puts it in, but we have to multiply that by 100 because of this spinner box business. Okay, and then we're going to, now, we're going to put a couple of those outputs in here, and we put range, no, cells, and you put row, comma, call, equal range, and you put sponsor, sponsor IRR. Remember that? Okay. And then let's put this one, cells, row, commas, equals developer, IRR, and then we put the next one, and because we're going around the columns, and then we put developer and PV. Okay, and then you put next call, and then you put next row. That's how fast you can do this stupid thing. And then you, before we go here, right here is where we should do the goal seek. And you just put it like this. And then you're finished. You're finished with the little incentive thing. Now, I'm afraid of this because I did it so quickly. I'm following my Napoleon rule, and I'm going to maybe put it right here. We'll put a button right here, and we can attach this button to any of these things. And we can, of course, assign this macro to this one, which is table 2. See, I did have a table 1 already there. And we can run the table. Okay? Now, I've got to stop the video. I'm afraid to do it in front of all my people who might be watching, all the one person who might be watching. All right, let's review my mistakes. Number 1, it wasn't that bad. I had to multiply by 1,000 instead of 100. This stupid thing didn't really work with the start column. I had to, if I would have done this, I would have had to put start column plus the go around a loop from columns 1 to 3. So I did that badly. I just did it by hand. What the hell? You'll get the model. So then you do this, and then let's try this. Let's try to make a graph. Now, if you make a graph, rule number 1 is let's see if it's flexible. Let's really see about this. So I'm going to move these things down to here, and notice I didn't have this one here, and then I'm going to make a little alternate F1 and put this little graph here. And how did it work? But, you know, screw this series. Let's put this one, format the data series. Let's put that on the secondary axis, okay? That's because it's, and maybe screw this, let's get rid of this, select data, let's take the NPV out. Is that okay? And then we can kind of see, does this work better with a line? I shouldn't be leaving the video on for this kind of crap as if you can't do this yourself. I think it might work better as a line. Okay, and now this is the fun part. Okay, let's put a different kind of incentive in. Okay, and when we put a different kind of incentive in, let's okay, sorry, I'm helping Diana do some stuff, and let's put a lower flip rate. Oh shit, people are coming in the door. I'm making a video, god damn it. And now I'm gonna redo this. Okay. And then I get a different kind of line. Isn't that cool? And then I put a different one here. Excuse me, I happen to be making a video here. You could show some respect to my video viewers. Okay, and then I'm gonna have to end the video now, obviously. Okay, and it's 50 minutes, so that's okay.